How's everybody doing?
Happy
Good. I love your
Halloween.
hand in the back.
Happy Halloween.
The
Right.
hand is that's not seasonal. This is here all year.
There doesn't surprise me about you, actually. I like it.
And the skeleton. I don't know if you can see that one.
I thought it was a mold of Luke's face, but
Oh, this. Yeah.
yeah.
I'm a
He
little
just-
disappointed that Luke is not dressed up for Halloween. I thought for sure we would have some badass 80s something or other.
I considered it, but thank you for noticing that I didn't. Although Avery's is ironic because we are going to be the Addams family this evening, and
So
the hand
cute.
is appropriate, even though it is there all year. And Ace, the rest in peace. He just passed, the guy with the mask behind Avery that got brought up. So that's horrible, but rock and roll lives forever, right?
Yes. Yes.
I love you, Luke.
Yeah. See, now I feel like our background is so boring,
Yeah, we need
Almost nothing.
we need a hand.
We
to
need all
still the
sorts of
face.
stuff. Scary face.
All right, guys. So I guess we'll get started, or else Luke will just chat the whole time. So thank you for coming. For those of you who are new, I know we've got a lot of short-term shop plus people in here, got a lot of new people in here. So we are there's been a lot of questions because it's towards the end of the year. Oh my God, I got to do something about the short-term rental tax. Not loophole. We decided we don't want to call it a loophole anymore, right? Amanda?
Right. The advantage.
Short-term rental tax advantage. Anyway, so it's kind of like we're down to really the wire on being able to get you guys under contract on a property, being able to get you closed so that you could actually qualify for this by the end of December. But I have some really great folks here to kind of it, because normally I have to say in these things, I'm not a CPA, so make sure you ask yours. But we happen to have the best real estate CPAs that you can find in the US. And Amanda and Matt at Keystone CPAs. I'll let you guys introduce yourself because y'all are rock stars. But they're gonna talk about it real quick, and then we'll start taking questions on acquisition as well as the loophole, not loophole. Sorry.
So we're gonna keep doing that, guys. Okay, you have to take a shot every time we say the word loophole. Okay, could be a shot of water or a coffee.
We're off to a good start on Halloween.
The new word is short-term rental tax advantage. All right, let's see if we can do this. Well, thank you guys so much, Avery and Luke and everybody, for having us here. Super excited. My name's Amanda Hahn.
And I'm Matt McFarland. Our firm Keystone CPA. We're based in Southern California, but we have worked with investors all over the country. And our clients is all real estate investors, and runs from getting started to running the full gamut of being full-time real estate. And obviously a lot of them invest in short-term rentals. So it's what we're excited to talk about today.
Yes. So yeah, one of our passions is just in educating people on how to use real estate to save on taxes. As you guys probably already know, tax law favors real estate investors because the government wants to incentivize us for starting businesses, providing housing. And for most people, who were interested in real estate, you've probably been told by your CPA that real estate tax benefits do not apply to you. So common things that are heard is the real estate benefits you hear people talking about on social media only applies to people who do real estate full-time, people who don't have a job, or people who have lower income. And none of those are true when we're talking about short-term rental tax strategies. And earlier we were chatting about why do we call it a loophole, right? That sounds like a kind of there's a negative connotation around the word loophole. But the reason why most CPAs call it a loophole is because unlike traditional real estate, where if you invested in a rental property, you take write-offs, you take depreciation, you can only use it to offset your W-2 income or your business income if you are a real estate professional, meaning you have to do real estate almost all the time. That has to be your full-time job. So for a lot of folks that we work with, they have a full-time job, right? Working at a regular W-2, you might be a teacher, you might be a doctor, you might be working in tech. And then the question comes up is how can I still invest in real estate and use tax benefits to offset my W-2 income? And the short-term rental investment is one of the only ways you can utilize that. In other words, if you invest in short-term rentals, we don't care if you have a job. We don't care how much money you make at a job. We don't care how many hours you're working at your job. All we care about is the fact that you own a short-term rental and how many hours you are spending on the short-term rental itself. And if you have the right amount of hours, then you can use short-term rental tax benefits to offset W-2 and all types of income. So who does this work for? Virtually everyone, right? Teachers, physicians, CPAs, we have social media influencers, athletes who use it. Just everyday people who work are all able to utilize this tax strategy.
Yeah, and that's why we love it, because it's IRS almost, why they treat it differently than long-term, midterm rentals. Go, I don't know, go talk to a congressman from years ago, right? But it's almost like they treat it like a separate business. So if you're actively involved in that business, if you are putting the required hours, and we can talk about the different, material participation requirements and things in order to treat that short-term rental as almost like an active business. If you're doing that, then we can utilize those tax benefits. And it's pretty powerful because, again, if it's both spouses are working, making $300,000, $400,000, $500,000, but you can utilize the short-term rental loophole and take advantage of cost segregation and accelerated depreciation, create those paper losses, and we can use those losses to offset W-2. It becomes pretty powerful from a tax planning and wealth building perspective.
And then just go ahead.
Matt has to take a shot. He said loophole. Sorry, go ahead. I had to call that out.
And again, so you understand why it's called a loophole, right? Because the traditional law for rental investments is you have to basically quit your job and do real estate full time. But in the short-term rental space, it's a loophole because you can literally keep your full-time job and real estate could be a side hustle and still use all of the tax benefits of write-offs, depreciation, and all of those good things. And also too, with the passage of the One Big Beautiful Bill, right, that was signed into law in July of 2025, what brought back for real estate investors was 100% bonus depreciation. So, we had a client who bought a property in June of this year, about 500,000 was the building. So initially they're looking at about 70,000 of depreciation paper loss. But after the passage of the Big Beautiful Bill, it's now going to be a little over 150,000. So you can see old law, we can write off 40% of bonus. New law, it's 100%. So now we've more than doubled our tax benefit after the passage of the Big Beautiful Bill. And so that's why, at least for us, we're seeing a lot of clients, a lot of investors getting more aggressive in acquisition of rental properties. So a couple of things that we care about, right? We said we don't care about how many hours you work at a job. We don't care how much money you make. None of those matter. What does matter is what you do with respect to your rental properties. So the hours requirements you have to meet is what we call material participation. And there are 7 different ways to qualify, but 3 are the most common. Okay, the first one is you have at least 500 hours in your short-term rentals. So if you are furnishing, staging, handling guest communications, scheduling your cleaning crew, totaling up to 500 hours, then you can use the loophole or advantage. And that means you can take your rental losses against W-2 and other income.
Yeah, now obviously as we're moving it, we're into Q4, right? And I know a lot of you guys are looking at purchasing additional short-term rentals like our clients are. So obviously if this is your first property, getting 500 hours in the next 2 months is obviously going to be challenging, right? So the benefit of that is that there's other tests you can meet. So if you can't get to the 500-hour test, next one you can look at is, did you spend at least 100 hours this year working on your short-term rentals? And it's more time than any other single person spent on it. So example, you have 130 hours, you look around and your cleaning person had 85, your gardener had 90, and that was the most anyone else had, then you've met the requirements. So again, it can be treated as an active business, create a loss, you can use that loss. Now, if you can't get to 100 hours for some reason, then the third test you can utilize is you look at your time, and as long as it's more than everyone else's time combined that worked on your properties, then you've met the test. So again, you add up maybe you had a contractor do a light reno when you bought the property. Somebody came in and staged it for, I don't know, just add up the hours. Anyone who spent time working on it, as long as yours is more than everyone's combined, then you've met that third test. So you just have to meet one of them. So again, going back to Q4, those last 2 tests are the ones that our clients utilize a lot, very common in October, November, December, obviously, because you could buy a property, close on it, get it staged, get a light reno, up in service in December, get a couple turns on it. So as long as the average stay is 7 days or less, and you can meet those requirements, then we can take advantage of the advantage. That's it. That didn't sound as good as take advantage of the loophole.
All right, can you guys see the PowerPoint? So I just want to share an example. So this is someone that we are working with in 2025 currently. We usually, when we share these kinds of client scenarios, it's just something that's happened in the past, so we have exact numbers. But I felt like it was more powerful to share something that's currently being worked on in progress, because again, one big beautiful bill really changed a lot of stuff. So we changed the name for the clients, just for privacy purposes, but the facts are true to the clients. So Scott is a teacher and Darla is a physician. So this is the first year they're using STR loophole. Their CPA initially said, you can't do it. You're doctors, you're teachers. It doesn't work. You have to have, real estate professional status. But we talked about, you don't have to have it. Okay. So for them, first time investors combined, they make about $600,000 of income between the two of them. And in the first year, they bought 2 STRs. I think a little bit, it was right before the summer. So just to kind of give you guys an idea, what are some of the numbers we were looking at for them. So total income, 623, 2 STRs, their income is projected for this year to about $29,000, net of just regular operational expenses. When you own rental real estate, you can take advantage of like business deductions, right? Because you're a business owner now. So income shifting, paying their kids to help out with their rental properties. Short-term rentals are really great for income shifting because there's a lot of things that your kids can do for you, especially kids who are a little bit older, right? And especially too, if the property is local to you. So income shifting, just small stuff, writing off their car, travel, business development type things that most investors have, but miss out on. But here's the big one, right? 2 STRs, about $550 each. First year depreciation is just under 300,000. So 289 is the depreciation benefit. And then you can see their income went from about 650 total, including rental, down to 349.
Now, obviously on the depreciation side, they are taking advantage of doing cost segregation studies on the property. They are taking advantage of those changes under the one big beautiful bill, where now when they can accelerate a lot more depreciation because we've got 100% bonus depreciation. So that same benefit, had they bought the properties last year, would have been a lot less. The depreciation would have been less than half of that. So obviously they're taking advantage of the current year changes in the tax law.
Yeah. So this is not actual savings, but I don't know. I put saved, but I mean projected. So projected savings would be about 112 for this couple. And I think a lot of times we get questions on like, is the STR loophole only for high income earners? How much money do I have to make in order to utilize it? And it's not just for high income earners. Even if you're not making $600,000 a year, it works just exactly the same way, right? The strategy is the same. You just have, fewer zeros behind it. If you buy smaller properties, it works exactly the same way, just smaller numbers we're talking about. So hopefully that kind of gives you guys a really quick framework on what are we talking about? Because I know people always like to see numbers, like you're talking about all these different things, but what does it look like in practice when you look at it from a taxpayer's perspective? So that's it. We'll give it back to Avery and Luke.
All right. So thank you guys so much. So y'all, why I've always loved Amanda is because I don't have a numbers brain to understand a lot of these things. And she dumbs it down really well. She explains it really well for somebody like me who just doesn't, my brain does not compute like that. Luke's does, mine doesn't. So always appreciate y'all's explanation of these things and making it easy for people to understand. So guys, the purpose of this call is for those of you who feel like, oh my gosh, maybe I should, I think I need to do this by the end of the year. So we're here for questions. For those of you who are new to the short-term shop, we are real estate agents. We have offices in 20 of the top short-term rental markets. We've got all different kinds of markets, beach markets, mountain markets. We've got markets you can start in at $2 million. We've got markets you can start in at $250,000. So we try to have options for every price point and every investor. So we're here and we have a lot of our agents in the different markets on this call. I'm not going to go through everybody who's here because it'll take up too much time, but agents, if you want to drop your name, market, and contact info in the chat, or we'll hook them up. Actually, let's see, we'll do. Agents, just drop your name and tell them who you are in the chat. since I can't introduce everyone. And then Luke will drop a link to how to get in touch with our agents. So we're here for any questions about the investing side of it. And Matt and Amanda are here for questions on the tax side, which we already have a few in the chat.
I'm just
So-
here to talk to Luke. I don't know.
Yeah. Well,
Oh,
thank
Luke-
you. Thank you. Yeah. You know, we're the Abbott and Costello of real estate over here, but
I like that.
yeah.
Does anybody still know who those people are?
Yeah, I was gonna say maybe I just showed my age there, but
An older crowd, guys.
It's all good.
they were silent screen, you know. But anyway,
Mhm.
I wouldn't mind if you can break it down a little bit more as far as real estate professional. It just comes up all the time, you know. Or do I have a spouse that maybe could qualify for real estate professional? Can you explain rep status like for dummies, basically?
Sure, sure. And just I want to start with like if you are trying to use the short-term rental tax advantage / loophole, you don't have to be a real estate professional. Okay. So again, if your CPA is saying, oh, you can't use it, you can't use the short-term rental loophole because you're not a real estate professional, that is your first sign that they don't know what they're talking about. They don't understand the STR loophole. So who cares about real estate professional is anyone who owns long-term rentals. Long-term rentals, single family, commercial real estate, self-storage, mobile home park, those are all long-term rentals, generally speaking. When we have long-term rentals, if we, we create a tax loss through write-offs and depreciation, if we want to use our long-term rental losses against W-2 or business income, either you or your spouse has to become a real estate professional.
Yeah, because once with the long-term rental market space, once you make over $150,000, the IRS doesn't let you use rental losses against W-2 and other income unless you can qualify as a real estate professional. So that's one of those where, you need to spend at least 750 hours a year in real estate. You need to spend more time in real estate than your other job, which can be challenging, obviously, if people are working full-time jobs. And then you also have to meet the material participation requirements. We talked about those for the short-term rentals, but as part of your overall hours for long-term rentals and real estate professional, you have to meet those requirements for your long-term rentals. So being involved in your long-term rentals. So again, if you're investing in short-term rentals and not investing in long-term rentals, you don't care about real estate professional status. But obviously some do both. Some have been investing in long-term rentals and getting into the short-term rental space. So yeah, for sure it comes up.
Yeah. One thing I do want to say is for the real estate professional status, like we said, it's difficult if you work full-time because you have to have more time in real estate than your job. But this is also what we refer to as the real estate marriage tax loophole, where if you're working
Another
full-time,
loophole.
if you're working full-time, high income job, you have a spouse who's a stay-at-home, or maybe they're working, but they make a lot less income, right? It could make sense for that second spouse to try to qualify as real estate professional status. If they don't work, if they already don't have a job, they just have to have 750 hours in long-term rentals. If they have a job, then often what we do is a calculation to say, okay, well, if you stopped working, net of tax savings, because now you're going to be a real estate professional, what is the net take home amount for the family, right, as a whole? And sometimes, we end up in a scenario where it makes more sense for that second spouse to stop working full-time at their W-2 job.
All right, we've got a lot of questions, so I'm going to try and group a few. And then, yes, we want to take Ryan's question live too. Let me ask a few of the most asked questions and we'll grab you, Ryan. So how many stays do you need? Like if we're trying to close this year, how many stays do you need? Do you need at least one booked stay? And what happens if you get it up and running, but you don't get any stays by December 31st?
I mean, so I think you'll get different answers depending on which CPA you talk with. For us, best practice, what we recommend is you have at least 2 stays or 2 bookings. And so that way, and why 2? Because the definition of a short-term rental is a property where the average guest stay is 7 days or less. So if I just have 1, it's kind of hard for me to say the average. I guess I could, right? But if you have 2, then it's irrefutable. Like, okay, I had 2 stays and they're both 7 days or less. But the key though is placing it in service. So for those of you who are like, hey, I'm closing on the short-term rental, it's going to take me 3 months to get it up and running, and it won't actually be available until 2026, then it will be a 2026 strategy. So you still get to utilize all the stuff we talked about. It will just be delayed 1 year. So if you wanted this year, try to get at least 2 bookings and 2 stays. That is kind of the gold standard.
Yeah, because the challenge with if you list it, advertise it, but not able to get any stays, then kind of the default in the tax world, it's going to almost like default to a long-term rental. Because how can you show that it was a short-term rental if you didn't have any, if the average, you had no average stay, right? Like, so that's the challenge with that, is that so, and I think we get questions all the time too. Well, can I rent it out to, like, you know, what if I just rent out to like family and friends at the last week of the year or something? Like, you can certainly do that. Obviously it's best if you have some, you know, you can show the listing was on Airbnb, Vrbo, one of those sites, right? You got a contract in place, you're collecting rents for them. But the key is that the rents need to be fair market value rents. If you're just renting to a couple of family and friends for, you know, 3 days each, and you got, you know, 6 total days, average stay is 3 days, or, you know, 3 days. If it looks in like, hey, the average stay should have been, I don't know, 800 a night, you only charge 100. If that came up in audit, you'd have a hard argument to make that you were, you know, charging fair market value rents. Excuse me.
Along those same lines, how does it work for a long-term rental? Like, let's say I don't get a tenant by the end of the year, and I am a real estate professional, and forget about the whole short-term thing. How does that work?
So long-term rentals are a little bit different. So for a long-term rental to be placed in service, the only requirements are it's advertised and available by the end of the year. So I have a listing that says it's available for someone to move in before December. The IRS does take it as placed in service already. Again, for the short-term rental, the same rule could apply, just advertised as available. But it's just a little bit more tricky, like Matt said, because we have that extra definition of average guest stay during the year. And if we don't have any stays during the year, it's a little bit iffy on whether you can win that argument if you were, you know, in front of
And I think just
right?
playing the devil's advocate, right? Think about it from this perspective. If we're taking advantage of one of these strategies, the numbers are not going to be, we're not saving $1,000. We're saving, you know, we're taking deductions of $50, $100, $200,000. We're saving a lot in taxes. So you want to make sure you got your, you know, dotting your I's and crossing your T's, right? You don't want to lose an argument because I didn't have a, you know, semantics or whatever, right? Like,
Yeah. Ryan, we'll go ahead and take your question.
Yeah, thank you. Okay, so if I can articulate this right, but my question is twofold. How would this process work, or would it be any different if you close under an LLC instead of your name?
No difference. So whenever we talk about short-term rental, or even long-term rentals, the LLC or lack of LLC doesn't change any of the stuff we talked about so far. You personally are the one who's going to earn the hours. You can deduct the same expenses. You can pay your kids the same way, regardless of whether you hold title personally or in an LLC.
Okay, and then the second part to that is, does it matter if you, like, say I close this year, but don't get it up and running before the end of the year? Is it still fine to use this depreciation next year? I just have to meet obviously the material participation. Is there any complications for doing it over 2-year period?
no, and then no, you totally understand. So yeah, that happens sometimes. Obviously, you're going to close on a property in December, you don't get it up and running. But the beauty of that is that, like, let's say we fast forward to 2026, you can meet the material participation requirements next year. You can still do a cost seg next year. You still get the benefit of 100% bonus depreciation on some of those cost seg items. So it's still available to you. And to your point, you definitely want to use the strategy in the year that's going to make the most sense. So if this year, I don't know, you're in a very low tax bracket, but next year I'm going to get a huge bonus or, you know, increase in pay. Well, maybe you'd want to save it for next year anyway, right? Like, you know, assuming you meet the requirements both years.
And it could be any year, just so you guys know. I think there's a misconception. Like, when I buy it, I have to have the hours this year. I have to do cost like this year. It doesn't have to be. So, you know, like Ryan's example, like I bought it this year, it's not in service yet, or it's in service, I don't have the hours yet, or I just don't want to do it yet. I can always do the same thing in 2026 or 2027 or 2028. I can choose which year depending on my overall income, so I can save the most in taxes. And in fact, if you buy something this year and you don't do cost like this year by choice, when you do it next year, not only do you accelerate from the future, you also catch up for what you didn't accelerate in 2024. I'm sorry, in 2025. So 2026, in my example, will be like a much bigger year because you're kind of squeezing everything in from past and future into one lump sum.
Gotcha. Thank you. Appreciate it.
Awesome. Love it. Jennifer.
Hi, I'm pretty sure I know the answer, but I want to hear it from the experts. I'm about to make my first purchase closing in November in Gulf Shores.
Awesome.
And my full-time job, I'm director of property management, and I assume that I already meet material participation because it is my full-time job, correct?
So you get paid as a W-2?
Yes.
Okay. So the way it works is for W-2 income, that is not considered business income for you unless you own 5% or more of that company. So like if I'm working for a property management company, I want those hours to count for me. I have to own at least 5% of that business. If I don't, then I'm just an employee. So it goes against me. But if we're talking about short-term rentals specifically, remember for short-term rentals, we don't care how many hours you're working at your job at all. All we care about is your hours in the short-term rental itself. So if you're closing in November, I would try for the 100 hours in the STR or any hours as long as everybody else combined is less than you.
So the material participation is going to be measured based on your hours spent on your own properties.
Yeah, we don't care about work hours.
I see. And can my hours that I invested in the short-term rental prior to closing count?
So it's a good question. It's kind of a gray area in the industry, I guess, for the tax world. The way we look at it is once you're under contract, the hours you're spending from that point forward should count towards material participation. You kind of before that researching a market, looking at 10 different properties, that time won't count. But again, once you got it under contract, you're going through your due diligence before it closes, you should be able to count that time.
Great. Okay. And then just to be clear about the bookings, in the event that I get 2 bookings before the end of the year, they need to be 7 days or less.
Yeah.
For the
Yeah, I
tax
mean,
advantages.
each individual,
Average.
the average does, obviously you can have one at 12 and one at, 1 or something like that, or, whatever that math works out to be in my head, but.
Yes.
You guys
Well,
are
I agree with.
awesome. Thank you so much.
Awesome. Kane. Good
Yeah,
to see you.
so we talked a lot about hours and such, and mine's more about tracking those hours and being able to report them accurately. So like I currently do everything and just track it in a spreadsheet just because I sit in front of one all day, so it's easy for me. Is it okay to track it like monthly and say November was 10 hours for this, 5 hours for this, 2 hours for this? Or do I have to do like daily, minute by minute kind of tracking? Because I want to make sure I don't get, if I get audited, that
Yeah.
I have everything kind of accurate.
Sure. And just so you guys know, we don't talk about this a lot, but we always recommend tracking hours because if you're audited, what the IRS typically will do, and we've seen in audits, is they'll ask for your time log. And from your time log, they'll do a sample selection. So if it's made up of 700 lines, they'll probably pick 10 or 15 and make you prove those. So from that perspective, right, if one of the lines is the month of November, then there's a lot more work for you to do and come up with November, I spent 60 hours. What did I actually do? And compile all of the details. So from that perspective, I say the smaller the increment, the better it is. I want you to select something that was like 15 minutes and I can pull an email and say, here you go, this is what I did. And so the level of detail will kind of depend on, what your preference is, knowing that's kind of how it works in audit. And what do you include in that? Baseline date, right? Property, and what I did, the amount of hours I spent. The description of how detailed it is, what I always tell people, best practice, have enough detail where it will prompt you to know how to prove something, right? And you can even shorthand it. We have, in our template, we have an Excel tracking template. It's like, okay, how am I proving this? It's an email, it was a text, it was calendar, whatever that document is. So, because basically at the end of the day, the whole purpose of tracking is to protect yourself on an audit, right? So we're saying, okay, auditors asking for it. What do I really want them to see? And how difficult is it for me to prove it?
And thank you for all that. And if we're spending like time in something like Price Labs, looking at pricing and stuff like that and adjusting, it's hard to prove that we were in there doing analysis and everything, but I'm guessing everybody here spends at least an hour, I'll say an hour a month, even if it's 10 minutes a day, every 10 minutes or whatever, 15 minutes a week. I don't know. Is that
Yeah,
legit?
I think that's where no, yeah, that's totally fine. I think that's where it comes down to being detailed, organized, and reasonable, right? So if you got somebody were audited and hey, I plugged in 8 hours on one day for price labs versus somebody was like, hey, I did 0.6 hours, you know. So keeping track of time, definitely recommend daily. People, it's a pain in the ass. I get it, but like, it's going to look more organized to an auditor and they're going to give more weight to that than the person who kind of does it a couple times a month, just based on our experience. So I think the more detailed you are, now we grew up in a Big Four background where they ingrained, tracking your time in 6-minute increments. You probably don't need to do that, but for sure, every, quarter hour is probably a good baseline
Yeah.
at a minimum.
And it also depends on what you're doing, right? If you're, if you have a out of state property, you're there for, the whole day. That might be like an easier 8-hour thing. Like here's a
Yeah,
list,
yeah.
here's a story of what I did this whole time. I think a lot of people question whether the STR has to be local to them, a lot of our clients especially. So we have a client who in California invested in 2 STRs, one in Florida, one in Texas, well, joint client. I won't say the name, but one in Smokies, one in Florida. He was audited. Agent automatically disallowed the whole thing and said, well, Airbnb manages all the stuff for you. And you're in California, so you don't get any of the write-off. And so the whole audit was basically us educating the auditor, like, what does Airbnb do versus what do we do? Or not we, but what does the client do? And ultimately, it ended up in a no change audit. So they ended up accepting everything. But just so you know, we talk a lot. I mean, you guys probably know more about short-term rental tax loophole than a lot of CPAs. And then if we apply that to even auditors, they don't specialize in real estate, so they don't know a lot about this kind of stuff. And so just don't be scared if they automatically disallow it. It's also an educational process for them too, if you're ever audited.
Thank you for all that.
All right. Karen, we just did you, right?
We did not.
Oh, I've just been looking at you, waiting for you to go. Okay.
I'm ready to go. Okay. I'm going to try to do this very succinctly. So bought our first STR in 2024, so closed in October, in service in February, one W-2 income earner. I'm going to consider it high income, married, will hit the 500 hours in 2025. And so now I'm trying to figure out, my accountant friend, happens to be my sister-in-law, was like, you don't need to do cost segregation. That's this whole other big thing. You're not big enough yet. Next year, W-2 income will be significantly less because I changed jobs. So it will be significantly less. So I feel like this is the year to get the tax break, but not really sure what we should be thinking about. I think that was.
Yeah, for sure. I'm glad you're looking at it like a year ahead too, right? Because that's what we do when we look at planning. It's not just about today, this year. It's also looking at the next year too. What am I expecting? So what your sister-in-law told you is super common that we hear from CPAs, especially in the short-term rental space, because traditionally cost segregation was used for large commercial real estate, multifamily, medical buildings, because it was very expensive to get done. And the benefits weren't a lot. But the facts have just changed, right? Now with technology, after COVID, the studies could be done remotely. So you don't have to pay someone to fly out to your property to do it. So like, a couple $1,000s, you can get it done. And so the cost has gone down and the benefit has increased significantly, right? We now have 100% bonus depreciation. And so it's just about looking at the cost benefit analysis. I would say most of our clients do STR loophole, have single family homes. A lot of them are under $500,000. And where the traditional CPA says that's too little because they only look at millions of dollars, absolutely, it makes sense. Like even the story we shared with Scott and Darla, right? The 2 properties, 500,000 each, got about almost 300,000 of depreciation. And so, if depending on what tax bracket you're in, if you're 30% tax bracket, that saves you about, that's going to save you like a third in taxes almost.
What a lot of Karen, what a lot of cost seg companies will do too is they'll give you like a free proposal. So they kind of give them the property address, give them a little fact, what you paid for the property. They can look it up online, and they'll kind of do like a free estimate, for lack of a better term. And that way you can use that to see like, okay, well, here's the extra depreciation I'm gonna get. Here's my tax bracket I'm gonna be in. It's gonna save me X dollar amount because I'm gonna meet material participation requirements. It's gonna cost Y. Is there a cost benefit there? And obviously we would assume there's going to be based on our experience, but you'd have to run those numbers, obviously.
From just a vernacular perspective, is cost segregation study and bonus depreciation not the same thing, but like one happens as a result of the other? Like you don't get
Yeah, it
bonus
doesn't have, it doesn't
depreciation.
have to, but like when you're talking about, I guess a good example would be you buy a property, you pay X dollar amount for it. There are certain things in there that you can take bonus depreciation on, but in order to do that, you have to do a cost seg study.
Okay.
Versus you buy a property, put that aside for a second, then you put $200,000 into it and a bunch of improvements. If you have the detailed list of all those improvements, there's certain things in there you can take bonus depreciation on, and your real estate CPA who should have experience that could look at that and figure all that out without having to do a cost seg on the improvements. So it just depends on kind of what aspect you're talking about. So hopefully that kind of helps a little bit.
Got it. Okay.
Yeah, somebody in the chat said, my CPA told me short-term rentals don't qualify for bonus depreciation because they're not commercial. Is that true?
No,
No.
in fact, they are commercial. Well, bonus depreciation applies to all kinds of properties and just business assets too. We always talk real estate, but you know, I mean, for our CPA firm, if I bought a car, I can use bonus depreciation. So it's not just for commercial or not non-commercial real estate. I think they're talking similar to what Karen was saying, like, oh, because it's not big enough of a property. But again, like Matt said, just get a cost benefit analysis. It's free, right? It's free. Instead of just saying, no, we can't do it or it's too expensive. Let's see, what is the cost? What is the benefit?
Wait, can you explain the car thing here just like real quick? You know, it has nothing to do with what we're talking about today, but let's say I bought it's got to be over a certain weight and it has to be for my business, something like that.
Just say Luke's in the market for a new car.
Yeah, you know.
Hypothetically speaking.
Yes, I mean, it could be applicable to the STR, right? So like if I bought a short-term rental in the local mountains and I also need a new truck or SUV because that's how I'm going to handle, I'm going to self-manage and do all that. If you purchase a vehicle, you can also take bonus depreciation on that car as well. Any kind of car is eligible for bonus depreciation, but there are caps around how much you can write off for vehicles. That is different than rental real estate. The reason you always hear people talk about a car or SUV over 6,000 pounds is because when it exceeds that 6,000 pound limit, then there's no maximum amount. So if it's like $100,000 car, you can potentially write off $100,000 if you're using it for your short-term rental, provided it's over that 6,000 pound weight. Versus if it's like a sports car, then there's a cap. I think it's like 30,000 or something in the first year when it comes to bonus depreciation. So any car will qualify, but yes, the larger ones are the ones that faster benefit through depreciation.
Love that. And we're going to keep motoring through because we have a lot of questions. Luke, I heard you start to ask another one, but we're going to go to Sarah.
Hey, we are Sarah
Get muted.
and
You get
Leo.
muted, Luke. Hi, Sarah.
Hi.
Hello. So my question is more related to capital gains. So let's say that you buy a short-term rental and then you do the accelerated depreciation. Would that hurt you at the time that you sell the property?
So it yeah, anytime you buy a property, whether you're doing cost seg and kind of supercharging depreciation, taking regular depreciation, that depreciation expense is going to reduce what we call your basis in the property. So you buy it for 500, you take 100 grand of depreciation. Now your tax basis is 400. So when you go and sell, we're looking at sales price minus our $400,000. So certainly the depreciation is going to increase, potentially increase again on the back end. In a perfect world, if you're looking at doing a cost segregation study on your properties, it's on properties you're going to probably own at least 3 years, if not 5 years or more, just from a present value of time value of money savings perspective. Having said that, we have clients that do cost seg and turn around and sell a property 2 years later. There's certain things we can do on the back end to kind of help reduce the depreciation recapture taxes. You can still do a 1031 exchange in the back end to still minimize some of that effect. So it's not the end all to be all, but it's certainly something to consider.
Questions on the bonus appreciation. Does it apply if I use it, let's say, to rent out extra rooms in my primary residence? Can I still use that?
It's a little bit different. So it works if you move out of your home and turn your home into a short-term rental, you can use the loophole. But if you're just like renting out your room or renting out part of your house when you're not there, you can still take depreciation and write-offs, but you're limited to you offsetting the income it generates. So it's not the same as like we get a big loss and offset W-2.
So basically it allows you to like offset the income you're generating, but then not really be able to offset like your own W-2 and things like that. So it's just kind of a nuanced tax law.
Oh, so it doesn't offset my W-2.
Not unless, like as Amanda said, if you move out and you're just renting your primary residence by rooms, and you can start, everyone's a short-term rental, that works. But if you're living in a property and renting out a couple bedrooms here or there, it basically limits your ability to kind of create losses and use them against your W-2, at least on that property.
Okay.
I see
Thank
a
you.
couple good questions in here that are from like same question from a couple different people. So just address that for everyone. It's with respect to combination of hours. So yes, if you're married, right, any of the one you 500, 100, if you're married, you can combine your hours together. So Luke and Avery can combine their hours together. Matt and I can combine our hours together. If we're talking about partners unrelated, so Luke and I are partners, we cannot combine our hours. So, but as a married couple, you combine your hours for the requirements, and also you can group your properties. So I have a local STR in California. I have 3 in the Smoky Mountains. I can group everything together, so I meet that 500 hour or 100 hour more than anyone else. So I meet that all at the same time. Keep in mind, if you're using the 100 hour requirement and grouping, the second part also has to be true, where nobody else spends more time than me across my different properties too. So I saw that like a couple different ways being asked. So hopefully that addresses it.
Good job.
Oh, there's one about travel time. So travel time, does travel time count for material participation? It depends. So if you are traveling for material participation activity, so I am going to the Smokies because I'm going to be setting up my Airbnb, then those do count. Alternatively, if you're traveling for unrelated things, they don't count. So in other words, I'm traveling to Vegas to go to BPCon, nothing to do with my actual rental properties, that travel time will not count. So travel counting or not depends on what you're doing when you get to the destination.
All right, Crystalie, are you ready?
Yes.
Oh, there.
Yeah, sorry, I'm just trying to look for the unmute button. Yeah, so I type it in the chat, but I think it's just easier to just say it. So we got a property earlier this year. So for that, I think we already met the 100 hours material participation hours. Now, if we get another property in December, I will likely not be able to meet the 100 hours. So I understand that there's that third option where more there's like as long as you spend more hours than everyone else, then that's fine. But I feel like that is harder to prove when you get audited, right? Now I read that there's also an option that you can group your properties. But I'm not really sure how that works. Maybe if you guys can expand a little bit more about grouping your properties and what are the tax implications on that later down the line.
Sure. So grouping your properties, really all it means is that you are telling the IRS that when you're looking at the material participation test, you're looking at the test as a whole across all your properties. So actually on your tax return, like if you guys ever look at your like 1040, there's a Schedule E where you report your rental properties. They got different columns for each rental property. You're still putting each rental in its own column. There's nothing changing there. It's not like you're putting them together as one column, but you're just adding an election statement to your return saying the IRS, hey, for these 3 short-term rentals or 2 short-term rentals, I group them as one activity and for purposes of looking at whether it's active or passive. So in most cases that's going to work out. Now, if you happen to have properties you've owned for like 5 years and you've got some carry forward losses because it was passive before and now it's active because you meet the requirements, those are situations you might have to look at and analyze whether it makes sense to group it with other activities because could be a tax detriment down the road if you sell one of those properties. I don't want to get into the nuance of it, but other than that, if it's just like you just bought a property last year, bought another one this year, probably no downside to making the grouping election.
And then just so you guys know too, that's where you want to make sure you work with a good CPA who understands real estate, because when we do tax planning, the first step is we review tax returns, right, for people, because it tells us a lot about what they've done in the past, any missed opportunities, and also exposure areas. So one exposure area, exposure meaning like if you're audited, this might be a problem. One exposure area we find all the time is not making these elections. Like Matt said, it's just a piece of paper that's attached to the tax return when it's filed. But because it's an attachment and not like go to this form, check this box, that's the stuff we see missed all the time. And the issue is, and we've seen this on actual audit for like people we know, where if you don't have that election, then technically the default is you have to meet these hours with respect to every single property. So like if you're someone who has 5 short-term rentals, it's going to be difficult, right? If not impossible to do 500 hours per property. It's like the number of hours in the year, right? To be able to do that. And so it's those little things, just making sure. And you know, if you don't know if it's there, just, you know, don't assume it's there. Ask your CPA before the return is filed. Can you show me where the grouping election is? And this is important for any of you who own more than one short-term rental, right? Ask them, show me what page I can see that grouping election. Because again, it's not on a form, it's not a checkbox. You have to actually have a piece of paper for it.
And kind of following that conversation too, right? Like looking at the 3 different material participation requirements we've talked about, obviously the 500-hour one is only, you know, they're only looking at your time or you and your spouse's time, right? So that's the only thing you have to prove. Granted, the other 2, you definitely have to have, if they ask, you have to be able to show how many hours the gardener spent, the cleaner spent. So there's pros and cons to each one for sure, from an audit perspective and a, you know, documentation perspective. But again, if you're buying a property late in the year, you're not going to get to 500 hours. You're going to use one of those tests, and you just have to be able to have your ducks in a row.
All right. Christian, you're next.
Yes, hi. So I have a question about the material participation hours. So previously I had been advised that you shouldn't start counting your hours until you place the property, you know, that it's available and ready for rent. Earlier I heard you say that you could start tracking them as soon as you're under contract. Is that a choice that you can make, or is it always one or the other? The reason I ask is because we're going to have some, you know, contractors doing capital improvements, let's say, you know, 150 hours, and now we're here towards the end of the year. Would it make sense to wait to list, you know, let's say in 3 weeks or something, you know, late November, list then, start tracking my hours then, get 100 hours between my wife and I, or should we start tracking now and try to beat however many hours the contractor had?
Yeah. You know, I think the beauty of the tax law is that it's law, it's interpretive, so it's not black and white. And so what you're talking about here is there's 2 different CPAs having 2 different ways of interpreting the tax code and how they look at it, right? So I think, yeah, conservatively, you're saying, well, I'm not going to track any hours until it's placed in service, or aggressively, I could start tracking hours earlier rather than later. I think it comes down to whoever is going to file your tax return, right? Because that's the person that's going to defend you in court.
Okay.
But normally, yes, well, the way we typically look at it is after it's under contract, it's material participation because now whatever you're doing is involved in the day-to-day operations of the property. Like if I'm not building furniture, it's not going to be an STR, right? But I think like you're saying, it also works in the reverse, where I have a lot of people spending time on construction and I have to overcome their time because now I'm already a property owner. So yeah, I mean, that's definitely something to take a look at, because
Okay.
the way we look at it, that is somebody working on your property you already own, right?
Right. Right. Okay. All right. Thank you. I appreciate that.
A couple of questions about refunds. Like, hey, if I pay W-2 taxes already, can I get a refund after this? Yes, that's the, you know, if you overpaid and now you have the strategies before year end, you get a refund in next April. How long is the process? Very, very long, guys. And the government is shut down now. It's probably going to be even longer. We have clients who've waited over a year for a refund. So a better way to do it is to plan ahead. I know kind of late for this year, but for those of you who are using the strategy next year, as soon as we know you're going to buy a short-term rental, we have you lower your withholdings because we want that money. We want to keep that money every month
Sooner.
rather than waiting until next April to file a return and then wait months and months and months and months for a refund check. And even then, when you get a large refund check like that, oftentimes it could be a red flag for an audit, because now the IRS is sending you a check, right? And so sometimes they're like, well, what happened? Why am I sending you such a big check? So be more proactive, you know, get that money back rather than waiting for a refund.
Great information. Sharon, your turn.
Hi.
I have two questions, and the first one is related to markets and or specifically the real estate or short-term rental operations of it. I am looking to buy my first STR, and in evaluating properties that are essentially like turnkeys, let's say they've been an STR, owner is selling it, seller selling it, fully furnished, all of that stuff. And I'm just curious, what's the best approach to getting the STR into service in the transition so that it cash flows right at closing? Because I know that there should be, I mean, I don't know, first time, right? So just kind of, is there downtime? And obviously if this property has a lot of reviews and all of that stuff, does that kind of carry over? And how best to carry over? And yeah, so that's my first question, and that's probably directed more towards to Avery and Carl. Avery.
It's yeah, a lot of male first names rolling around in this room. So that's a really good question. So the reviews will not carry over. You'll have to start your own new Airbnb and Vrbo accounts, and you'll start fresh. And what you'll need to do is price pretty cheap to start out, so you build that review base, but also to make sure that you get a couple rentals in place before the end of the year for your tax stuff. And in terms of will you start cash flowing very quickly, it depends on what the seasonality is of the market that you're buying in. So if you're buying like a beach house down here, like a big beach house, it's going to be harder to start cash flowing in December because it's the off season here. Whereas some of the other markets aren't quite as off during December. Like the Smokies is on full on in December. So just depends on your market. It's totally doable to get a rental or two down here to meet your the requirements for your tax stuff, but it can be difficult to get enough to, really get rolling. But that being said, so if you close in December, your first mortgage payment is not going to be due until February 1st-ish. So you won't have that big, huge payment until those, in February at the beach, you'll start to see spring break bookings rolling in. So just kind of depends.
Got it. And so okay, that I understand. So I think I'm just trying to like evaluate it. Is it worth like doing turnkey, like buying a fully like ready to go thing versus, that downtime of like trying to furnish it and all of that stuff. My second question is for Amanda and Matt in regards to real estate professional versus the STR loophole. What is the biggest difference between the two statuses, I guess, in regards to deductions?
In terms of deductions, there's not much difference. Basically, excuse me. The main difference between strategies of real estate professionals, if you're trying to use long-term rental losses to offset W-2 and other income, the short-term rental strategy is to use short-term rental losses to offset W-2 and other income. And they have, obviously, as we talked about, they have different requirements on how to meet each. But outside of that, deductions, depreciation, I mean, short-term rentals depreciate slightly different than long-term rental. But other than that, they're basically the same. It's just a matter of what are you investing in and which one can you take advantage of.
So property managers and stuff like that, is that something I've read that it could be if you were a real estate professional that is considered something you can take a deduction? I don't.
Well, nothing you can't take a deduction for, but we have clients that have multiple long-term rentals. They self-manage enough of them that they can meet the hours requirements and material participation requirements. But then in some of their long-term rentals, they have property managers on them because they're out of state or whatever. It doesn't make it that you can't qualify. It obviously, from a high level, makes you ask the question like, well, if you have property managers on every property, well, how are you doing a lot of the hands-on stuff that you need to do to meet material participation for your long-term rentals?
Thank you.
You are so welcome. Ryan.
Yeah, Amanda, Matt, hopefully this isn't a dumb question, but we've been talking a lot about benefits. I'd be curious to know, are there any special circumstances or reasons why you may not want to do this bonus depreciation? I know one of those you mentioned maybe lowers your cost basis and potentially increases your capital gain risk, but I would assume if you're planning on holding long term, that's a non-factor. But are there any reasons to not do this?
Sure. Well, cost benefit, right? If you have a property which is the purchase price is very low and or land value is super high, right? Because we can't depreciate land. So if I buy a property that's beachfront in California, where 90% of my purchase price is land, then maybe I don't do a cost seg if the benefit is the tax benefit is less than the couple $1,000s I'm going to pay for taxes, for tax savings. The other one, you can mention, if I'm selling pretty quickly next year, I may not want to do it. I just kind of have to weigh the pros and cons and what my tax rate will be next year versus this year. I think the third one, which is the most common one, is people prematurely do cost segregation and trapping in the benefits, right? So let's say you bought your first STR now, you don't meet the hours this year, there's no way you're going to meet it. Well, then don't do cost segregation yet, because if you did do it this year, it gets locked in the passive loss bucket, which means it only offsets passive income. And what a lot of people don't know is even if I do meet the hours next year in 2026, it does not free up these passive losses. So they go into like tax jail and they're there forever to slowly eat into passive income. So timing is super important. And I always tell people, cost seg sounds really great, because the stories we share and the stuff you see on social media. But before you do a cost segregation study, you have to make sure you talk to your CPA, because they're the ones to tell you whether you should do it. First of all, when should you do it? And also which property should you do it on? If you have multiple properties, we might not want to do all of them at the same time. Right, we might want to do a couple this year, a couple next year, so we get your tax bracket from 37% to 20%. So every year you're saving at the 37% bracket rather than just do it all, get to zero tax, because now I'm only saving at 12%.
So if I'm understanding you correctly, if you decide to go ahead and do this and you get audited and you fail, you can't, there's no redo.
Well, I mean, no, that's a separate conversation. What I was saying was, if you do the cost segregation this year and you don't have hours, right? You don't meet the hours, but you went ahead and did it anyway, the cost segregation, then on your tax return, that loss will not offset W-2 income. It just gets trapped. So it just carries forward and offsets rental income slowly. Whereas the better scenario is I do regular depreciation this year, then I cost seg next year, because next year I will automatically offset W-2. Right. So the facts are just different for people. And then I think we were talking, was it Jennifer or someone we were talking to earlier who said, oh, actually my income is highest this year, but my sister-in-law said I can't do it. But in that fact, I want to do it this year. I have the hours, I have high income. Let's do it this year because next year I'll have less benefit. Right. So it just differs from person to person.
In that scenario, can I do another cost seg study next year to fix that problem, or no? You can only do one?
No. So when you do the cost seg, if you're passive, it already locked it in, right? The IRS saw the return. They saw a $300,000 loss. So you can't cost seg the same property twice. And what you do next year does not change the facts of this year. That's why it's locked in.
The only exception to that is, I think I saw this in one of the questions, was you can cost seg the original purchase price like this year, and then maybe next year you do a huge major remodel where you're spending $200,000 to $300,000. You can get a cost seg on the improvements next year. That's a difference, but you can't just re-cost seg the same purchase price over and over again.
I wish we could do that, but you can't do it.
I would like to say how awesome this is, and thank you guys for being here. This is amazing. So thank everybody for being. We've got well over 100 folks. We peaked at about 150 folks on this call. That's amazing. Thank you guys, each and every one of you, for being here. I'll take it to Philippe. Where are you from, brother, and how can we help?
Hey, good afternoon, everyone. Yeah, Philippe, based out of LA, sales engineer. I've been working with Yak, looking for some properties in Blue Ridge area. Just got pre-approved for $700,000 purchase price. So starting to do some underwriting here, and I'm fairly new to the short-term shop. Just joined last week, so things are moving pretty quick. We've been talking a lot about the cost segregation study and bonus depreciation, but I'm kind of curious to hear your thoughts on some other ways that we as business owners could have some tax advantages other than just a cost segregation study. So of course there's the business expenses, right? And the best practice from my understanding is just to set up an LLC immediately, so you have a separate business bank account, easy to track all those things. But for someone like me living in LA, I'm renting an apartment, but I'm using it as a workspace. So could I technically use a portion of, you know, my apartment and a portion of my rent as a business expense, things like that.
Yeah.
So
It's a
Yeah, there's actually a lot of different things that that you can still do between now and the end of the year to save on taxes. You know, like I said, over 40% of tax returns we review are not optimized for tax savings. So if you're wanting to know whether you have opportunities to pay less tax, I put our link below. We joined forces with Short Term Shop to put together a free tax risk assessment. It's just a self-assessment. So you can go online, check it out. I put the link in our chat box below. It asks you questions about your personal investment and business activities, and then you'll get a score on what your current risk is. And also you can use that as a guideline, Philippe, to say, okay, what are some of the things I'm not doing already? So yes, home office, maximizing deductions, retirement account is a big one, right? How can I pay towards my retirement rather than the IRS? This year, we can potentially shift up to $70,000 or more per person into retirement. And depending on your age, you know, you can even do like over 100,000 into retirement account rather than to pay taxes. Obviously having the right legal entities is going to be key. If you're not in the right entity now, making sure you have the right entity before the year's over, running payroll for yourself, optimizing it rather than just haphazardly, you know, taking payroll as I need money. Those are all really great things. For California specifically, or any of you guys who live in a state with high taxes, I know not in Florida, there's no states there. I mean, there's no taxes there, but regular folks like us who live in states that actually have high income taxes, making sure that your business entity pays for your personal state taxes is a huge one. We see that missed all the time. And that's basically the IRS saying, hey, if your business pays your personal income taxes, you can take a write-off for it, versus if you pay that tax personally, it's a personal item and you can't write it off. So those are just some of the you know, some of the big ones that come off the top of my head. But yes, business owners, real estate investors, there's so many things that you can always look at from a planning perspective.
can you open up that last part that you just mentioned about your business income paying your personal taxes?
Sure, it's called it's called the pass-through entity tax break. Okay, so for those of you who have businesses, S corps, partnerships, where it's profitable. So there's a lot of you who are like realtors, you know, brokers, anyone with 1099 income, business owners. The new law, or new as of a couple years ago, is that your entity can pay for your personal state income tax. So in California, my you know, our corporation pays our share of California state income taxes, and it becomes a business deduction. Historically, personal income tax is paid by me as a person, so I can't write it off. So it's just a different way of having the business pay for something and writing it off.
Right.
Yep.
All right, thanks, Philippe. Juan.
Hey, first of all, this is great. Thank you, everybody. So I'm actually a real estate agent on 1099, and we just purchased our first short-term rental in September with you guys, and my wife is W-2. And the question that I have is that I'm pretty sure I'm already a real estate professional. Do we also need to meet the material participation under the short-term rental piece? I guess that's the question. Do we also need to meet that requirement?
Yeah. Great question. So the answer is yes, because short-term rentals and long-term rentals are in different buckets for tax purposes. So just because you're a real estate professional, because you're an agent and you also own long-term rentals, it does not automatically mean you can use the short-term rental tax loophole. So you do separately have to meet those hours requirements. For people like that, our strategy is actually the reverse. So we don't want the property to have average guest stay of 7 days or less. We want it to be more than 7 days, right? And so because if the property could be a short-term rental still on Airbnb, but if the average guest stay is longer than 7, then it's treated as a long-term rental for tax purposes. Then you no longer need to separately qualify for the hours. So that's the loophole around the loophole.
That's 2 shots in one.
2 shots in one. I'm out of my water. But and so that it's done typically with, you know, STR in the peak seasons, and then just have a couple midterm stays during the year, midterm or longer, so that for the year you pull the average above 7.
Got it. But at this point, we don't have long term. We just have the short term. and we plan on, going full boat.
So then, yeah, you
this
just have
year
to
with-
meet, you have to meet the material participation requirements with respect to your short-term rental then.
Yeah.
Got it, with 100 hours.
Yep.
Yeah, one of those tests, yeah.
Okay. Got it, thank you.
Go ahead, Andrew. Where are you from, buddy? What can we help with?
I'm Andrew from Texas. We have a short-term rental in Branson. We've worked with the short-term shop before to get all this done. I've kind of a four-part question though. First question is, if we're traveling, Branson's a big area for Christmas decorations. So let's say we're traveling from Texas to Branson to decorate for Christmas. Does the time log mean when we leave our house to when we get back to our house for hours purposes?
So it'll be your travel time, right, to get there, and there'll be the hours when you're working on the property, and then your travel back. It would not include like sleeping, that like when you're not actually working on the property, so you can't count your sleep hours.
Okay, then second part of the question is expenses. Let's say we took an airplane to get there. Does the air flight count as expense along with meals and any expenses that we incur during that time?
As long as the primary purpose of the trip is business, so kind of they look at did you spend more than 50% of your working days there as business days? Then yes, your flight to and from can be deductible. Meals on business days can be deductible. Hotel costs for business days. Anything that you're doing that's not business related, like you're going to an amusement park or something, as example we always give, that wouldn't be tax deductible. But yeah, generally if you want to maximize the number of business days you're there, so you can maximize those expenses.
So you mentioned amusement park. That's my third question. We get a lot of questions from guests about Silver Dollar City. So if we say we're going to go to Silver Dollar City so that we can answer these questions better, does that count as a business expense, even though it's amusement?
Maybe, possibly you can count that.
Okay. Then my last question.
You don't want to keep documents of, kind of what you're learning, obviously, right?
Okay. Last question is, if we have a rental in Branson and then we decide, hey, we're looking at a rental in the Smokies. We travel to the Smokies, we do a lot of research while we're there, and we decide not to purchase a rental in the Smokies. Does any of that expense count?
Yeah, you don't have to actually own a rental or have, you don't have to already own or end up purchasing in a location. But the key thing that we always recommend is that you have predetermined business activities, right? So obviously before you leave, connect with the short-term shop, know exactly which dates, which properties you're going to be looking at, get all that scheduled, right? Local property managers or whatever it is. That's going to go the longest rather than just well, I was there for fun. I happened to check out some properties, right? That's what the IRS is looking for. And that's what Matt was referring to earlier about intent. What was my intent in going there? My primary intent.
All right, thank you.
Yeah.
All right, Surgeoner.
Sorry, I was on mute.
That's okay, go ahead.
I was just distracted a moment. So I guess the question, and forgive me if I missed the question earlier, I was a little late to the call. If I have a property and I don't have a lot of hours because I took bonus depreciation the year previous, 2024. So I understand that we don't really need to continue the 100 hours participation after the first year when you take bonus depreciation, correct? Is there any point to continuing on with the hours in the following years is the first question.
Yeah, only if you still have a loss for some other reason on the property, but no, if you don't have a loss, then that's the only property. There would be no reason I can think of to keep track of the hours.
It's basically like a one-time event, and you just do the 100 hours for that 1 year. You're taking the loss and move on, right? If I did, somebody asked, I think I heard a bit of a question before about having multiple properties and having to have 100 hours per property or together. And I think I heard you say that you could opt for a group election, which meant that you could use 100 hours for whatever amount of properties. You only have to do the 100 hours. But question was, I'm not sure if I heard, does it matter if those properties are each under different LLCs?
It doesn't matter. No, it doesn't matter. Yeah, that doesn't matter. You can definitely group properties that are owned by different LLCs. That happens all the time.
All right, so new LLCs, I'm buying another property this year and maybe one in the spring, different LLCs. Next year, I only have to, or this year, I only have to do 100 hours total for whatever
But
amount of
but
properties
keep in
I-
mind, you're now when you're opening that up, if you got multiple properties, you're looking at a test across, you have more hours than any other single person across all your properties. So it's not just, somebody over on property one might have spent 120 hours versus nobody on property three had that many, but you still have to compare that to the person with the highest
All right, so
hours.
that's interesting. So I'd have to pay attention to making sure that I still meet that part of the rule, which is more time allocated to
yeah,
property
for
than
sure.
anywhere else
For sure.
on each of the properties I do. So then could you partially group some of them? That you got 4 properties, 3 of them you do most of the time, one of them is a manager, you exclude
You
that?
can do that too. You can select which properties to group if
I see.
there was a reason or benefit to doing it that way.
Yeah,
Okay,
just so you guys
so-
know, the grouping election that goes with the return, it lists the property address, or you
Oh.
list the property address. So you
Oh.
can say, I'm grouping these 3, but not the 4th one. But the grouping election, it is what we call irrevocable. So meaning once you group those are always grouped together. You can add to it, but you're not subtracting from it unless the property is sold.
So why I'm sorry that I didn't have another question until you said that, but why would that matter anyway to me? Why would I care if they ungrouped? If you couldn't do that later, if you've taken your bonus depreciation, why would that matter later?
I mentioned earlier, there's a reason why you may not want to group things if you've got carry forward losses related to certain properties. But that, again, that's a kind of a technical nuance, so
Yeah.
not worth getting into, but.
Okay.
You just ask your CPA if there's a downside to grouping.
Okay, you're my CPA. I'm only kidding. Not yet.
I don't know your name. I can't
No,
tell
I
from
was
the-
kidding. Like you're
There's
going
so
to
many
be my
people, I don't know
CPA.
actually know who's talking.
Well, thank you, Amanda. Appreciate it.
It sounds to me like
Okay.
Surgeonary is getting dangerously close to becoming full-time real estate, and that would maybe solve some problems for him.
All right, Luke, Amanda and Matt have to go. So guys, thank you so much for coming. You can go to, if you guys want to sign up for a consultation with them, you can go to keystonecpa.com/the short-term shop. And obviously, if you want to work with us, you can go to theshorttermshop.com. Thank you guys so much for coming.
Thanks, guys. Good to see you as always. Thanks, everybody.
Luke and I will stay on for questions, but we're not CPAs. Thanks, y'all.
Yes, and just so everybody's aware, this is going to be recorded and it will be on Short Term Shop Plus. We'll make it pretty easy to get a hold of. Of course, you guys were here, so might not need it again, but.
All right, so Chandra.
We'll wrap the last couple questions, Avery.
Yep.
No, Chandra? All right, Philippe, go ahead, buddy. In Los Angeles.
All right. Appreciate you all bringing Amanda on. Yeah, that was very helpful to ask those questions. So just moving on, I guess now to underwriting. So yeah, I'm starting to look at some properties here. I've done some underwriting for long-term properties, long-term rental properties, but now I'm starting to look at price labs, AirDNA tools like that. And so I'm really just looking for some practical advice and things that I should be keeping top of mind as I'm going through these exercises. So this weekend, I'm just going to be underwriting a bunch of properties. So any type of tips would be greatly appreciated. Thanks.
Any of the short-term shop agents who are on here want to take that one?
I mean, so, long story short, just never stop obsessing. That's my recommendation. And you can, everybody's looking for like a secret sauce to like, here, this house will make this much money. But unfortunately, an overnight rental with no lease and, there's no like document that says here, this is exactly what it's going to make. There's really no way to know. And I think it sounds to me like, Philippe, you've already done enough research to know that. And also rental history is, to be taken with a large grain of salt. It seems to be becoming more of a thing than it used to be. And people are definitely more interested in it now than they used to be. My advice is to get as many data scrapes as you can, get a subscription to all of them and just take them for what they're worth. Keep in mind, they are trying to sell you stuff. They're, taking your email address and selling it to other people. Lord knows what's going on behind the scenes, but it's definitely worth having at least one or two. Price Labs is, in my opinion, a must. You got to have Price Labs anyway if you're going to be in this business, with few exceptions. And also, the market dashboards on there are very helpful, and you'll use those moving forward too. That's the good thing about Price Labs, is that that's actually one of the very few data companies that, even after you own the home, you're probably still going to use a lot of their resources, as far as, you know, your neighbors and comparing your enemies on paper, and your competitor set is right there on your dashboard. Avery, do you have anything to add there?
Nope, you covered it all, I think.
Yellow pad and a
Hey,
pen.
one thing unrelated, since we have 85 people here, we're hiring agents in the Poconos and the Kentucky Bourbon Trail. So if y'all happen to be agents in that area or have a good one who might want to be introduced to us, send them our way. And yes.
Good time to wrap it.
All right. Yes, we are also looking for Park City. I forgot to mention that one. We haven't got anybody in there yet. So you can email me at avery@theshorttermshop.com or careers@theshorttermshop.com. All right. Well, thank you guys so much for coming. Hopefully this was helpful, valuable to y'all. Chris.
Oh, we lost her. Anyway, goodbye, guys. We love you. Thank you.
Yeah, happy Halloween.